Hello and welcome back to this channel. This is Unfiltered Forex, and in this video, we're going to be talking about balance sheet. And we're only going to discuss the assets part, not the liabilities, the assets part. Like we discussed in the previous video, balance sheet is a statement that shows what a company owes, and its worth, the assets, liabilities, and the equity. Okay. For educational purposes, we're going to be reviewing an actual balance sheet. There are a couple of websites you can get them from, but for this one, I'm going to look at MarketWatch. Here we can see a balance sheet. This is for the company Tesla. If you want to access the balance sheet, it's quite simple. In fact, let me show you from the beginning, okay? Type in the website marketwatch.com. Once you're here, you can search icon here and enter the company symbol or the name. Because you're looking at Tesla and I know the symbol, you can just type the symbol. That's the symbol for Tesla. Let's see. Then click. Here we are. Okay. Then overview, profile charts, financials. Go to financials and you can see the statements are here: income statement, balance sheet, cash flow, SEC filings. Okay. Select the balance sheet because that's the one we're looking at today. SEC filings, this is where now you'll find the official documents, the from 10Ks and 10Qs, 8Ks, 8Qs. You'll find them here. Now we're going to look at the balance sheet, and this is the annual one. Okay, we're going to go over the assets part. All right, in this video, we're going to go over the assets, not just of this balance sheet, but as we go, you will understand what this part is and what all these things mean. Okay, before I continue, there is another website that you need to know about: Seeking Alpha. Okay, there's another website here. Here we will be viewing the symbol Apple, AAPL. This is a company, Apple. You know what Apple do? They make and they manufacture and sell products like the Apple phones, the iPhones, tablets, iMacs, iPads, gadgets, the Apple Watch, all those. This is Apple. We'll also be looking at the balance sheet. Okay, the reason why I am on this website is because you can see this is a more bigger view of the numbers compared to what was here. Okay, this is going only back to 2023, and also there's the arrangement. You can see on this balance sheet, the latest numbers are on the extreme right. Okay, but on this one, the latest numbers are on the extreme left. This last report is the latest quarterly report, but these are annual figures. You can see this is an annual period. These are the latest reports from the quarterly filings, but these are all the annual ones since the year has ended. As you can see, this is September 2023. Okay, September. The, every company has their own fiscal year. Usually, and it's quite common, companies start their fiscal year in January and end their fiscal year on December. For governments, usually their fiscal year begins on July and ends on June the following year. Yeah, but for some companies like Apple, like you can see here, their fiscal year begins on October and ends on September. That's the fiscal year. Okay. Now, let me there's a reason why I have opened both tabs. You will see as I go. Okay, but for now, let's go over these ones. Period, annual. You can select quarterly or annual, but remember the annual is the better one, is the more preferred one. View absolute or YOY growth, or as a percentage of assets or liabilities. Absolute, these are the absolute numbers published by the website, by the company on their website. These are the absolute numbers. Okay, order, latest on the left, latest on the right. You can rearrange them however you want. And the currency is in United States dollar. This is the official currency that the company uses to report their earnings. Something else, you can see here, it's not indicated whether these numbers are in millions or thousands? So you have to scroll down here completely. Yeah, you can see in millions of United States dollars USD, except per share items. So all this is in millions. In millions meaning this 5, for example, this 5, this is 5 million, this 65, this is 65 million, this is 565 million, and this now is in the billions. So this is 25 billion. Okay, now let's begin. This is the assets part. Okay, assets, cash and short-term investments. Okay, cash and cash equivalents. There's a definition here. It refers to the value of a company's assets that are cash or can be converted to cash immediately. Cash equivalents include bank accounts and marketable securities, which are debt securities with maturities of less than 90 days. Okay, there is cash and cash equivalents. Cash is money in the bank accounts of the company. That's the cash. Okay. Cash equivalents are securities that can be quickly redeemed for cash with a maturity period of less 90 days or less. This is where we bring in US Treasury bills, right? Treasury bills in general are a common cash equivalent on the most of these balance sheets. Let me make a list. When we're talking about cash equivalents, primarily we mean T-bills, certificates of deposits, or other form of certificates that are given by banks and savings accounts. Usually, T-bills, by definition and what they are, these are short-term government securities with a maturity period of between 4 to 52 weeks. And remember, for something to qualify as a cash equivalent, you need to have a maturity period of less than 90 90 days or less. So 90 days, that's around 3 months, right? Yeah. 3 months, that's 12 weeks, I guess. Yeah, that's 12 weeks. And yeah, you can see most companies, they have treasury bills in their portfolios as cash equivalents, certificates of deposits, and savings accounts. The reason why cash equivalents exist is because of inflation, of course. Because if you keep money in the bank, and remember we are discussing billions here, okay? You can see here cash and cash equivalents. This is $25 billion, $29 billion, $23 billion, $34 billion. We are talking in terms of billions here. So if the company happens to keep money in the bank and that money suppose it's supposed to depreciate because of inflation, the company will be losing money in hundreds of millions. Okay, and that's a very bad situation to be in. So that's why most companies, they have these cash equivalents and throw their money into these T-bills that offer a small return. The return here, they're not that big, just like 2% or sometimes even below 1%, but they help keep up with inflation numbers and keep the money what is was worth at the time of collecting. Okay, yeah, that's the essence of having cash equivalents in the balance sheet. Back to here, short-term investments. Short-term investments represent relatively liquid investment having maturities of greater than 3 months and less than 1 year that are capable of being converted into known amounts of cash at short notice. So yeah, it's the same thing. These are cash and cash equivalents and short-term investments. They all fall under the same category. Okay. Now let's go over to the other part, receivables. Before we go to the receivables and the other part, let's check this Tesla page here and this Tesla's balance sheet. And you can see cash and short-term investment, cash and short-term investment growth, cash only, short-term investments, cash and short-term investments versus total assets. Okay, so the thing I wanted you to note about why I opened this other website is for these growth numbers. All right, when you're looking at a balance sheet, it's important to note how fast is the cash pile growing. How look when you're looking at a business, this in 2019 to 2023, 6 billion, 19, 18, 22, 29. You can see the growth percentages here. They are quite significant. And also back to seeking alpha, if you change the number here to YOY growth, now you're going to see how the numbers have changed in the past. Okay, coming from the latest going backwards. When the number is in brackets, this is standard accounting knowledge, basic accounting knowledge. When the number is in brackets, this means it's a negative. Okay, so this means from the last annual report to the latest quarterly report, there has been a decrease of around 10% in their cash pile. Okay, this 26% means the year-over-year change from 2022 to 2023 is an increase of 26%. That's what it means here. All right, let's go back to the absolute figures. Now we are moving on to receivables. Okay, accounts receivables. Accounts receivable (AR) is the balance of money due to a firm for goods or services delivered or used but not yet paid for by customers. Okay, then there are other receivables. So something you need to know about here is that goods sold on credit. All right, goods sold on credit, services provided on credit, that money that has not yet been paid to the company for a goods delivered or service offered is recorded here as accounts receivable, because remember, these are current assets, are assets that can be liquidated within a year under normal business operations, or assets that are expected to come in within the year in the course of business. Okay, so this is money that is outside the company, that the company is expecting to receive from the clients that have not yet paid them for services delivered. Okay, this is quite common, because in the case of Apple, for example, sometimes they may give out their devices to now the shops that are supposed to sell them, shops that are not Apple shops. So they give out their products, and they will be paid later after that other company has finalized their sales and is now returning money back to Apple. Okay, and not just the regular goods and services, but also other other business transactions, but primarily transactions involving trade, involving the primary operations of the business. Goods, services given on credit will be recorded here as accounts receivable. Okay. Other receivables. There's something that hasn't been related here. That's why I want to go back to this other balance sheet so we can check. Yeah, here we are. You can see total accounts receivable growth, accounts receivable net, accounts receivable gross, bad and doubtful accounts. All right. So among the goods sold, or rather goods or services sold on credit, there are people who do not pay their debts. Okay, people who do not pay their debts, or debts that the company expects these guys aren't going to pay us. All right. For example, if you do business with the government, some governments, they don't pay their suppliers on time. So if this company is, for example, supplied some goods to the government, and the government owes them some amount of money, it's going to be recorded here as a doubtful debt, because it's not very likely that that money is going to be paid to them, to the company, within the financial year. Okay. In fact, let's look at a balance sheet that has actual numbers here. Here we are. You can see this is Kavana, CVNA. That's the ticker symbol. This is Kavana. And accounts receivable, there's a gross amount, and there's even an amount for doubtful accounts. This is the money for goods or services sold on credit that the company doesn't think this amount is going to be paid by the clients. Okay. So it's going to be recorded here. Remember, in accounting, the negative numbers are recorded in brackets. Okay. That's how you know it's a negative. So there's an allocation for doubtful accounts, and this is how it's done. of the money you expect to receive for goods sold on credit, you subtract the one that you think you're not likely to be paid, and then you get the net amount, account receivables net. Okay, there's something else now, other receivables. Back to here, other receivables. These receivables include various forms of non-trade receivables which do not generally result from operations of the business. Okay, remember these accounts receivable, these are goods sold or services given on credit. But these receivables, this is other money, other funds that the company expects to receive, but this money that the company expects to receive is not related to trading activities. Okay, now let's get into understand what these are. Here we are, other receivables. Remember, this is money that the company expects to receive, but not arising from goods sold on credit. Okay, so loans to employees or loans to other businesses, interest receivables, advances paid to employees, tax refund, compensation, insurance claims. So, talking about loans, some companies do give loans to their employees. All right, you can be given a loan to go further your education so that you can come back and help the company. You can be given a loan probably because you asked for it and you need to take care of some health issues, or yeah, or the company maybe give a loan to another business for them to get the stuff together, and then yeah, so that loan that is expected to be paid back within the year is recorded as receivables. All right, the amount expected to be paid back within the year is recorded as a receivable. Okay, and then interest receivables, this is now interest on the loans. All right, interest on the loans or interest on other stuff, interest they expect to receive from arising from these loans or other stuff they give out. Another one, advances paid to employees. You know about advances, right? Like when you're stressed for cash and you need to be paid your salary in advance, the company will have to give you your salary in advance. But when now it's time for you to be paid, they're going to they're not going to pay you. They're going to take that money back to their accounts. So that's advances paid to employees. That's another receivable, right? Tax refunds, or maybe arousing from whatever cases. Sometimes companies do get refunds from the tax agencies, and tax refunds will be recorded among other receivables. Compensations, like if the company is being compensated, like a lawsuit, you will want a company is in court and wins a case versus a client, or if yeah, versus a client or versus whoever, if the company was being sued or suing someone, if they win the case, they will be compensated, and that compensation, if it's expected to come within the year, is going to be recorded among other receivables. And then of course insurance claims. For example, if the company if the company the factory or some property belonging to the company was damaged probably by a natural disaster, they are eligible for insurance from the insurance provider. So that money that they will get from the insurance claims is recorded as a receivable, other receivables. Remember about the annual reports in the official website document. That's where the other receivables will be specified in the notes section. It's usually there. You can go and check out for yourself. We're not going to cover that here, but it's usually there in the notes. It's usually specified other receivables. All right, back to here. So now look at we have looked at receivables, accounts receivables, other receivables, and the total receivables. Of course, this is going to be minus the doubtful accounts. Now, there is a ratio that let me check on this one. This is a better one. There is a ratio that is called accounts receivable turnover. All right. What this ratio does is it tells you how fast a company converts their receivables to cash. Okay. How fast they collect that money for goods and services offered on credit. That's what it means. As you can see here, other receivables, this is not very common. All right. It's not very common. That's why it's even called others. And most companies you will find it's usually blank here. But accounts receivables, there's usually something. Okay. So receivables turnover is a measure of how fast a company converts goods sold on credit or that credit to cash. How fast they convert that credit to cash. Okay, so how is this ratio calculated? This is the formula for accounts receivables turnover ratio. Okay, net credit sales divided by the average accounts receivables. Net credit sales, this we get it from the income statement. On the income statement, which we will look to and which we will look at in the next videos, there are sales for goods sold on credit. They are recorded there. So what you should do is how this is calculated is take the net credit sales divided by the average account receivables. All right. So the net credit sales, you can by definition, this is the number of sales done on credit, made on credit. Okay. For example, let's say a company sold $400 billion of goods on credit. And then, of course, throughout the financial year, because this you get it from the income statement, the same annual report, the same as this one, you get from the annual report. Let's say through the whole year, a company sold credit sales on credit to amounting to $400 billion. And then on the balance sheet, the average accounts receivable is amounting to around 30 billion. Okay, so we have 400 billion divided by 30 billion. This is the average accounts receivable. How the average is calculated is you take the sum of the previous year plus the sum of the current year and divide by 2. That's when you get the average between the two financial years. That average now is the one you're supposed to use on the formula here, average accounts receivable. You take the average of the current and the previous fiscal year. That's the average accounts receivable. So you divide by this and you will get a multiple, all right? Like you can see here, the sum or the result of this division is going to be 13.3. Meaning this multiple now means 13 times, okay? So it means 13 times throughout the year is when the accounts receivable was collected or rather converted to cash. Remember, the accounts receivable turnover ratio measures how quickly does the accounts receivable get converted to cash. Okay, so 13.3. You can do some further analysis with this number and say 13.3 times. So you divide this by 365 days in a year. You get 27.4 days. So this is a multiple, and this multiple means in a year, accounts receivable is converted to cash in 13 times. Okay, so you divide 365 days by 13 to see the average days. Okay, so this means like in 27 days, goods sold on credit is usually paid for. All right, in around 27 days. You can, since a month has usually 30 days, so this is around a month. Like every month, goods sold on credit for every month are converted to cash within the same month. Okay, that's what it means, and this is good, right? Now, but when you come here, accounts receivable turnover, this number is going to be the multiple. This is the multiple, not the number of days. This is the multiple. This result, this 13.3 That's that's the number here, turnover. Accounts receivable turnover 12, 15, 22. So the higher the better. Okay. The higher the better. And something you need to understand is that there is no benchmark for what number is considered good. Okay. There's no benchmark for what number is considered good, but rather what you are supposed to monitor is if it's increasing or reducing. So generally, a high ratio means there is efficient collection practices and you have good customers. All right, the customers you have mostly pay their their debts. All right, the goods they take on credit they mostly pay. Okay, that's what a high ratio means, and that's good for the business. If it's high and it's increasing, it's a good sign. But if it's high but reducing, it's usually a bad sign. For example, here this is from 2019 to 2023. We're looking at Kavana. You see, in 2019 it was 12, 15, 22, 8, 10. Meaning, at this point it was rising, which was good, but here it started dropping, meaning the company does not collect their credit sales as efficiently as a while back. All right, which which now even to determine if this decrease is good or bad, you also have to look at the volumes. All right, you can see this was only 200 million, 270 million, 365 million, but somehow this number picked up to the billions. All right, the total receivables. Yeah, the total is here. These are other receivables. The total is up here, 562 million. It's doubled to 1.59 billion, and again still at a billion, 1.08 billion. So you can see the receivable amount is growing and growing quickly, and so the ratio also is likely to get a bit diluted. Okay, and yeah, a bit, this can be called too much, but it's not a red flag at this point. Okay, it's not a red flag, but it's something you need to take note of. Let's look at Tesla. Accounts receivables turnover. You can see this Tesla, their number is quite stable at above 25. This is 28, 27, 27. Okay. And this is the latest one, 2023. So, in as much as their turnover, accounts receivable has grown by over 50%, their their ratio has maintained its level, which means that the business is growing, and as the business grows, their operations are also adjusting to efficiently manage the growth operations of collecting the debt on the receivables. Okay, now that's it on that one. The next one. Okay, now before I go on, I was talking about a high ratio. So a low ratio is going to be inefficient, is going to mean an inefficient collection process and bad customers. Okay, let me see if I can find a company with a bad turnover ratio. Well, we have an example here, but this is also not so bad because essentially a bad turnover ratio is something below 10, right? There's no benchmark, but something you would naturally consider a bad turnover ratio is if it's below 10. Why? Because remember, this is how many times in a year that the receivables is converted to cash. So if it's in the range of 10, and remember there are 365 days in a year, that means in around a month, all right? A month. In a month, all goods sold on credit, the money is collected and they start again. Okay, so that's what it means. So if it's below 10, it's going to be a red flag. Like you can see here, it was 7. This was not so good. But if it's below 10 and it's seen to be increasing or stabilizing at above 10, it's you can take that to be a good sign. All right, now let's move on. Inventory. Okay, we talked about the receivables and the current asset and the cash. Now we are talking about inventory. Inventory refers to all items, goods, merchandise, and materials held by a business for selling in the market to earn a profit. Okay, so inventory is the raw materials, the goods, the merchandise, the materials that are supposed to be sold by a business within a year. Okay, now this is one of the pointers I was telling you. Different balance sheets are going to be to have different metrics of measuring their profitability. Okay, so for example, here inventory, there are some companies when you look, you will not find anything on the inventory part. Mostly services companies, all right? This is Apple. So they sell phones, they sell computers, they sell all these gadgets. So of course there will be an inventory because even the raw materials that they have already bought that plan to be turned into final goods and to be sold within a year. This is around six. This is 6 billion. Okay, 6 billion, 6 billion, 4 billion, 4 billion, 4 billion. Okay. If you look at Tesla, you'll also find numbers on the inventories. In fact, this one is even more divided, is even more separated. So you can see better there's the worth of raw materials, work in progress, and finished goods, and the total inventories. Okay. For some companies, you will not find anything here. Even before I show you, you can already guess. A company like Meta, which is a social media company, they do not have anything on the inventories part because they don't sell anything. All they do is offer services, the social media platform. Okay, let's look at that balance sheet now. Here we are on the balance sheet of Meta, and you can come here, inventories. You can see inventories is blank, nothing, nothing, because this company, they don't deal in goods, they don't sell any goods. What they do is provide services. Also for companies, the financial sector, you will not find anything in the inventories because they do not have, there are no goods they're selling. You can see even here, this is finished goods, work in progress, or materials. These are irrelevant in some business models. Okay, so that's why company like Meta is normal to find nothing here. Another company is Google. Let's check Google. Yeah, this is Google now. You can see 2019, 2020, 2021, 2022, 2023. On the inventories part, they only have finished goods. There are no raw materials, there are no work in progress. These are probably goods they bought from another company that they were willing to sell in the coming financial year. There are products that Google does sell. What are they? I can't remember. Yeah, Google did have phones, right? There's a time they had Google phones, but now I don't think they do have those phones anymore. So you can see the inventories part here is mostly blank. Now, if you go to the SEC filing, the annual report, in the notes section, it will be explained why there are no inventories this year and last year there were inventories worth 2.6 billion. It's going to be explained where the inventories went and how the revenue was collected, if any. And yeah, there will be notes on what happened here if you go to the actual annual reports. All right. Okay. Now let's move on. There's something called an inventory turnover ratio. Cost of goods sold divided by the average inventory. Remember, the average inventory is the same as when you're calculating the average accounts receivable up here. Yeah, you just take the current inventory compared to the last year's inventory, you do the sum and then divide by 2. It's going to give you the average. And the cost of goods sold, this is also found just like on this other ratio. The cost of goods sold here is also found on the income statement. Okay, so there's the income statement, cost of goods sold, and then you're going to see that there. You divide that by the average inventory, and then you get the inventory turnover ratio. Yeah, unfortunately for this ratio, it's not usually listed here, but it's important you look at it. Okay, so what this ratio does is that it tells you how many times in a year does the inventory get turned to revenue, right? Or rather, how many times a year does the inventory get turned to cash? Okay, so again here, there is really no benchmark, like what index is good, what index is lagging. It really means just that, right? How fast, and it's really specific to different industries because it's essentially gives you an idea of the shelf life of the products that the company is selling. Okay, if we look at Tesla, for example, we try and calculate their inventory turnover ratio. You're going to take the cost of goods sold from the income statement. You can see this is the income statement, cost of goods sold. Let's try and calculate for 2019. Okay, 20.51 billion. Then you're going to divide this number by the average on the balance sheet. Okay, average of the inventory. Okay, you're supposed to use 2019 and 2018 average, but because that's not here and I don't want to do that work, you can just use this one. Okay, it's closer to the average since there wasn't that big of a change in inventories in this period 2019 backwards. Okay, let's use 3.5 billion. Yeah, if you divide the two, cost of goods sold by the average inventory, you will get 5.86. So what does this mean? This means like 5 times in a year, the inventory gets turned to revenue. Okay, gets turned to, or rather, the inventory is cleared out 5 times in a year. Okay, and this can be rounded up to 6. So if you want to get now the shelf life of the product that this company is selling, the shelf life rather meaning how long does this product stay in the market before it's bought. Okay, that's what I'm referring to as the shelf life here. You just have to do like we did with the um, receivables turnover ratio. You take 365 divide by this number, you get 60. All right, so this is 60 days. This means for every product in the inventory that gets sold, it usually lasts around 60 days on the market before it's sold. Okay, and this whether this is a good or bad number will determine on the industry. Okay, so this, remember, Tesla, their primary business is selling vehicles. So if a car stays 60 days before it's sold, it's not such a bad thing because a car is a durable good. Durable goods meaning they are goods that are meant to last, and consumers won't buy durable goods as often as they buy other regular perishable goods. Okay, so the shelf life of a car being around 30 to 60 days, it's not so bad. But if it was something else like foodstuff, if foodstuff was staying this long in the market, that wouldn't have been a good number. Okay, so yeah, again, it's not a situation of whether of the higher the better here, but rather it just shows you how fast the company turns inventory to revenue. And yeah, something else you need to do is, this is meta. Let's not look at, oh, this is the other one stuff. Just that, yeah. Something else you need to look at is monitor how inventories are balancing with accounts payable. Okay, remember we've already talked about accounts receivable. I'm skipping ahead for just to understand, to get to clear about inventories before we move on to the next one. Accounts receivables, when you go to the liabilities part, there's a part of accounts payable. Okay, accounts payable now is the opposite of accounts receivable. These are goods and services that the company has received on credit. So this is money they are supposed to pay out to other companies, probably to pay the suppliers or to pay some other companies, all right? But in this case, yeah, it's mostly to pay the suppliers of raw materials or other services. So you need to monitor the inventory versus the accounts payable. If you look here, the inventories is around 3.5 billion, and here let's look at the latest one for this one, 13.63 billion and 12.84 billion here. So now you need to look at the accounts payable for the same period. Accounts payable, you can see that one was 12.13, now here it's 15.14, meaning this company gets this company gets inventory that they haven't paid for yet. Okay, because if you have inventories worth 13 billion and you owe 14 billion to your suppliers, that means there are some goods that you received on a credit basis, and that's good. All right, because that means you are not paying your suppliers out of pocket, but rather you are paying them for after selling the finished final products from your inventories. All right, so this accounts payable being higher than the inventories numbers is taken to be a good sign for a business of this magnitude. Okay, so this means, like here, this is 12 billion and the other one was, and the payables was 15 billion. That means there's around 2.9 billion that is in credit. Right, they received goods worth 2.9 billion that is in credit. Okay, and I don't want to get too deep into this one at this point because we will have to revisit it later, but just keep that in mind. Okay, for such big businesses, receiving goods on credit is actually a good thing because the company now has more money to run the day-to-day financial operations, and paying suppliers, they're going to pay them once they have actually monetized their inventories. Okay, yeah, that's what it means. So moving on to other current assets, okay, because we're done with the inventories. Other current assets, as the name suggests, these are just other current assets, non-cash assets. This is not cash. These are non-current, non-cash assets that can be liquidated within the year. Mostly that can be liquidated or are in the plans of being liquidated within the year. Let's go back to Apple. Yeah, you can see here it's the same story. Other current assets, category of things of value that a company owns, benefits from, or uses to generate income that can be converted into cash within one business cycle. Okay, so yeah, this is the other current assets. One thing you need to understand about this number of current assets, this can be machinery. Yeah, this can be machinery, equipment, some factories or some products, not products, but rather assets that the company owns that they plan to liquidate within the coming year. Okay, this number should be kept small. Small, why? Small or nothing. Sometimes there is nothing. If you go to the actual annual reports, you will see on the notes section, it's usually explained there what these other current assets are because they're specific to a company. Okay, and for such a company like Tesla, in this case, you can see some of these other current assets. It may be assets they are planning to liquidate because either they are getting new equipment, so they are selling the old one, or just selling them because they're switching to a new mode of production. New technology comes along and they have to sell their old equipments and stuff. So yeah, that's where the other current assets come in. Okay, now moving on to the total current assets. This is the total number here. Okay, for all these assets, this is the total. And there is a ratio here that's called the current ratio, dividing the current assets by current liabilities. We'll get to that when you look at the liabilities, but for now, we'll have to skip this one. Okay. Now we are moving on to the non-current assets. Okay. Non-current assets, these are all other assets that the company owns that they are not planning to sell. All right. They're just assets Some of them are long-term investments, as you can see here, and most of them usually is buildings, lands, computer software, and equipment, accumulated depreciation on what they own. So yeah, it's recorded as a net asset here. Then long-term note receivables. Now this is the same as receivables here, but these are the ones that have been specified that they're going to take a while, not within a year. Okay. Yeah. So long-term investments, long-term receivables, intangible assets, and other assets. So something of important to highlight here is the intangible assets. All right. There is a whole story here with intangible assets. What are they? These are assets that lack physical existence. Okay. These are classified as non-current because they produce benefits over time. Okay, and we're going to understand that just in a few. Unfortunately, um, okay, before we go there, the value of intangible assets is due to the rights and privileges they provide to the company. Okay, that's why they are considered assets. Unfortunately, their value can be overstated on the balance sheet. Sometimes the assets here can be overstated because of some reason that I will get to in a few. The primary reason why some intangible assets are overstated is to make a company look more valuable than it actually is. Okay, and even to balance the balance sheet to make the assets match the liabilities. Some companies do overstate their intangible assets. So examples: trademarks, copyrights, patents, uh, franchise, client lists, goodwill. You can see goodwill here. That's another special case. Customer relations, the reputation of the business. All these, all these intangible things about a business, they are considered assets. Okay, but they cannot be used as collateral for loans. All right. Yeah. For example, Apple, they can't be given a loan from the bank because they have a good name. Okay, you can't do that. You have to have actual concrete assets for them to be used as collateral when you are asking for loans. So intangible assets aren't used as collateral for loans. Goodwill, you can see goodwill here is recorded as an intangible asset. Essentially what goodwill is by definition, it's the premium a company pays for buying another company. Okay, when a company buys, let's say Tesla had bought a small company that deals with solar batteries, making batteries for their electric vehicles. All right, so when Tesla buys that company, it's going to buy them at a premium. Okay, like let's say the company's assets are only worth $2 billion, and Tesla decides to pay $3 billion for the company. All right, the extra $1 billion is considered goodwill. Goodwill as probably the value of intangible assets of the company being acquired. Okay, that's it. By definition, price paid above fair market value for acquisition of a company. It reflects value of intangible assets of the company being acquired, such as brand name, brand image, customer relations, secret formulas, etc. Goodwill can either be written off due to impairment. Suppose the agreed company doesn't turn out to be as promising as projected. So that's another thing here. All right, let me explain. Goodwill, like these numbers you're seeing here, this is probably the worth of intangible assets of an acquired company. Okay, so they expect to either write off this goodwill or to increase it if the company that was acquired turns out to be more promising or less promising as projected. For example, uh, let's say they bought that company that manufactures batteries. Okay, so after they have bought that company, it turns out that they paid $1 billion extras, right? So it turns out that that $1 billion is recorded as goodwill, and suppose it's discovered that the technology that these guys were using isn't even all that. It's they were using old methods, and probably they had some machinery and equipment that was just not good. And not just that, but even the image of the company, they had a lot of they have bad relations with their suppliers, bad relations with the market, and in generally just a negative picture is painted for the company that has been acquired. At that point, then the goodwill that was paid, the value of the estimated goodwill that was paid is going to be reduced. All right. Again. When you look at the actual annual report on the website, you will find it on the notes part. How it's going to be explained the goodwill how the goodwill came to be and how it was either reduced or increased. All right. There's a whole notes section explaining these little things you've heard me talk about here. So yeah, goodwill. This is another one. So a red flag you need to monitor in companies when a company has too much goodwill or rather too much intangible assets. That is a red flag when they have too much compared to other assets. For example, here you can see it's 615 million, but the whole company's assets are 106 billion. So this 600 million is less than 1% of the total assets the company has. So this is not enough to raise concerns. Okay, but let's look at another company that their intangible assets are raising questions. Here we are. This is a company called Staff. Okay, let's not go too much into the name and details of the name because I don't want to make it look like I am defaming them. Okay, but you can see intangible assets $37 million, but the total assets are only $81 million. So when you see a company half of their total assets is recorded as intangible asset, that means there is a problem here. These guys are broke and they are overstating the value of their intangible assets. Overstating why? Because there is no way to actually determine the value of an intangible asset. So that's why some companies like these small ones, you need to monitor them on this part, the intangible assets. If it's too much like this is almost 50% of total assets. That's not a good thing. That one you need to ignore it. Okay. Yeah. And even compare intangible assets compared to cash and the other. Yeah, you can see here cash and short-term investments. How comes you only have $1 million? This is $2 million in cash. How comes you only have $2 million in cash, but your intangible assets are estimated to be $37 million? That doesn't make any sense. Okay, so this is how you check for some shadiness in companies' financials. This goodwill, this is usually a major red flag. Goodwill and intangible assets, this is usually a major red flag here, right? So other assets, now this is all other assets that the company has, but yeah, just all other assets. And I think we're done now. Yep, you can see here goodwill. Some companies don't have any goodwill, all right? And this is a good thing. A good thing how that they don't use the value of intangible assets to prop up their numbers. Okay, you can see this is the Apple balance sheet, and they have a total assets of $331 billion, but in terms of the intangible assets, they haven't stated anything. There is nothing here. All right. This is quite normal for such big companies. They don't they don't use these tricks. Okay. They don't use these tricks. These tricks of intangible assets, especially, is mainly used by small companies that are struggling to stay afloat to keep their numbers in check. All right. So that's it for that one. Um, yeah, I am done with this video. In the next video, we'll be looking at the current liabilities and then combining all the information. So for now, I hope you have understood something about and what all these numbers means. I hope now when you see a balance sheet, you will be able to analyze the assets very keenly. Okay, so that's it for this video. I hope you liked it. If you did, don't forget to leave a like, and of course comment on what you think I might have missed out and what you think I should cover in the next one. That's it.